All right, it looks like we're ready to get started. I'm Mike Vincent with FreightWaves. I'm EVP. And if I might tell you a little bit about myself, I have 32 years, well, almost 32 years in logistics, everything from LTL to truckload, ocean freight, air freight, warehousing, distribution, etc. Touched everything except railroad. In my times, in my past lives, managing $150 million, $250 million purchase transportation budgets was very, very difficult. Building the budget was difficult. Looking at historical data, looking at what the experts saw going into the future, what we saw going into the future, what our customers saw going into the future, a little bit of this, and setting those budgets was very, very difficult. Hitting those budgets throughout the changes during the year was even more difficult. Times when the chart looked great, times when the chart was upside down, looked bad. Freight starts moving, prices starts going up, market's heating up, getting blown out of the water on my budget. Freight starts to slow down, prices start to come down, starting to see some gains on my budget, and hoping that at the end of the year it comes in close enough, and hoping that I had the right excuses at the end of the year to say why we missed by this much or that much, right? Well, so when I got a chance to join FreightWaves, when I was asked to join FreightWaves with Craig Fuller, and I found out what he was doing there with bringing transparency and building these tools to de-risk the volatility or the exposure to the volatility in pricing, I jumped at that chance. And when I got there and I saw the team that he was building, this extreme tribal knowledge of C-level executives, years and years of experience that had experienced the same things that I had, and we're looking for the exact same goal, transparency and tools to de-risk that we would have killed for in our former lives. It was a no-brainer to join this team. And I'd like to introduce a couple of them, if I may, right now. Mr. George Abernathy, if you just kind of...
We'll do just a couple of quick introductions. My name is George Abernathy. I share Michael's passion. I'm the CRO at FreightWaves, so I look forward to the opportunity to network later on, but also wanted to talk about the passion. 3 years ago, I was the president of Transplace, one of the largest transportation management, third-party logistics organizations managing billions of dollars worth of freight, and if I had had the opportunity to de-risk any portion of that, I would have done so. And when Craig Fuller started talking about that to me about 3 years ago, he had me at hello. So I'm thrilled now that on March 29th, we're going to be able to bring freight futures to the market. So appreciate that. So I'll hand it off right now. Tom Mallon, introduce yourself, please.
Hi, my name is Tom Mallon. I'm Vice President of Financial Markets and Trucking Freight Futures. I joined FreightWaves about 1.5 years ago. My background is commodities, having spent 13.5 years at the NYMEX, and then almost a decade at information services companies, running commodity businesses at Thomson Reuters, at Interactive Data, and then most recently at Global View. So, welcome. And I'd like to introduce Addison Armstrong.
Thanks, Tom. I'm Addison Armstrong. I'm one of the newest members of the team here at FreightWaves. I've been around futures markets for over 20 years as both a trader and a broker and a marketer and a salesperson. Worked at trading firms, banks, brokerages. When I heard about FreightWaves and what they were getting up to and what they were trying to accomplish in the futures markets, I got very excited and basically beat a path to Chattanooga and convince them to hire me. So I'm glad to be here, glad you're all here, and we look forward to working with you. Thanks.
Thanks, Addison. So with that, we'll get started here. I'd like to talk to you about market size opportunity, what we're talking about here. What we're looking at here are three massive markets, highly successful, highly liquid, that have been started over the past few decades. We're looking at crude oil at $421 billion, natural gas at 138, and electricity futures looking at 390 billion, right? All massive markets, integral to industry and our economy, highly volatile price movements, within all these markets. You may recall that crude oil, its OPEC moment in 1983, right? The deregulation of OPEC nations started to control the supply of oil and make their money. The demand to de-risk that price volatility brought it in as a commodity to be traded. A larger market, a much larger market, truckload, U.S. truckload, $726 billion, 30% larger than pet coke and refined petroleum, larger than ag and electric power combined, 2x times electricity, extremely large. Integral to the industry and to our economy, absolutely. If you look at this slide here, the thing to take away here is that 84% of all the truck ton miles are made up of commodities that are being traded. The shippers, those that are using these commodities, hedging already these commodities, are also integrated with trucking. They rely on trucking. They're exposed to the price volatility of trucking. They're using them to move their goods. They're familiar with hedging. They're very familiar with the risks and the volatility, especially after 2018. Trucking is the largest mode of transportation in the U.S. It's not rail, it's truck. It's also growing faster than GDP. The freight industry transportation costs are 8% of GDP, and they're also one of the largest COGS, or cost of goods sold, larger than energy in many of the sectors. 40% of the S&P 500 companies have stated that transportation costs are the most substantial risk to their earning. Volatility of the truckload market. We've already talked about size of market. The truckload market is massive, 30% higher than oil, bigger than ag and electricity together, twice electricity. It's integral to the industry, it's integral to our economy. Everybody is involved in trucking. They're affected by the price volatility. They need risk. They need to be able to de-risk these prices, the price volatility. When you look at this chart right here, what you're seeing is the DAT van freight rate, Los Angeles to Dallas, from 2014 on. 136% increase in price since the low in 2014 to the high in 2018. Huge upswing. The important thing to see inside here are all the peaks and valleys. Massive swings of 60% or higher up and down in the pricing. Highly, highly volatile. What causes this volatility? Virtually everything that happens affects trucking and transportation. Government regulation, ELD mandate, the fear or belief that tariffs are going to be imposed causes containers to flood the West Coast ports, the East Coast ports, backing up warehousing, backing up drayage, sucking up the capacity in Southern California, driving pricing through the roof. Weather, hurricanes, FEMA, hundreds of loads, thousands of loads, capacity eaten up by FEMA, suddenly exits the market, ripple effect into other markets, and then when it's over, dumped capacity everywhere, affecting that pricing up and down in extreme measures. So we have a massive market that is integral to the industry and the economy, highly volatile. The major players are all looking for the ability to de-risk their exposure to the volatility in this pricing. So why now? Why hasn't it been done before? Well, one of the reasons is the gathering of folks that Craig has created at FreightWaves. But the other is really the ubiquity of telematics. And we've had devices, GPS devices. We've known where capacity is and where it's moving for some time. The proliferation of cell phones, though, now we have direct contact with those drivers and know exactly what's happening on the ground. We know the loads, when they're moving, the pricing on those loads, et cetera, et cetera. Cloud computing versus on-premise computing. From the largest to the smallest players now uploading real-time data into the cloud that is now discoverable in real time. The internet, interconnected systems, mobile devices, IoT devices, et cetera. Market forces, obviously capacity crunches, right? The Amazon impact, labor shortages, and the OPEC moment for trucking, transportation, the ELD mandate. Moving from paper logs to the ELD. No more two logs, no more two-log system, less efficient, reduction in capacity, volatile changes, volatile swings in pricing that we saw over the last year. So who's naturally exposed to these freight markets? We've talked about a bit of them. First, let me start with this. The freight futures are financially settled contracts only. There will be no truck showing up with one of these contracts. Okay, it's not coming. You can't take physical delivery of the goods at the end of one of these contracts. Purely a hedging or speculative. Totally separate from the contracts between the shippers and the carriers, the intermediaries and the shippers, and then the carriers as well. Completely separate. No truck is showing up. The players, trucking companies. Trucking companies are naturally long. They make more money when the prices go up. They need to hedge against those volatile downswings. 4,500 plus companies with $20 million or more in spend. Shippers. Shippers are naturally short. Prices go down, they love it. They go up like this year, they get crushed. They get crushed. A number of my friends got crushed right out of a job in many places. We saw in the chart earlier where is it here? Here we go. The spike in 2018 at the end, and the eventual crash thereafter. Wreaked a lot of havoc on folks. I've been evangelizing this for the last little over 2 years since I joined FreightWaves, and the conversations are, when can I get my hands on this? When can I start de-risking it? One of them is in the room here. We were speaking earlier. We first spoke about a year ago. First time I met him face to face, but he's been following right along, waiting for this. Move forward a little bit here. To the intermediaries, the 3PLs, which we'll talk a little bit, went past a little bit, sorry. The freight brokers are also exposed from both ends, right? They're signing contracts with the shippers, they're going out and they're sourcing, then they're going out and they're sourcing that capacity to fill those. So they're short and long depending on when you're looking at it, right? They're trying to hedge against that margin compression. We got our friends at K-Ratio can give you a little bit more insight into that. So what do you need to build this market? A large and volatile market. The largest, 30% bigger than oil. Extremely volatile. Even on its 136% rise from 2014, there were major crashes and rises in between. A benchmark index. Our partners at DAT, the Platts of spot market pricing discovery and reporting. 256 million electronic transactions measured per year. Over $60 billion in freight spend per year, which is over half the spot market. 700 plus different sources and 98 of the top 100 brokers report into DAT. And of course, our partners at Nodal, the leaders in energy, in the energy markets. They've also been along for the ride from the very, very beginning, helping us build this market from the very, very beginning, which is extremely important in negotiating those waters and making this happen. The marriage between the two, transportation and nodal exchange, may not be incredibly obvious, but power, electricity, is very, very similar to trucking. It's finite, it's perishable, it moves along a grid, and it's subject to regional volatility. Very, very similar. So the contract size, or the size of the market size potential. Approximately 40 billion miles annually in spot market miles. The contracts are 1,000-mile contracts. 40 million freight future contracts can be trading annually to help de-risk against those pricing volatility swings. With that, I'd like to turn it over to Danny at Nodal. Thank you.
That works. Danny Gomez, I'm with Nodal Exchange. A little bit by myself, I was part of the group that launched the exchange back in 2009. Joined in 2008. With me today is Dimitri Caruso, so I don't know if you mind standing up for the benefit of the people in the room. So if you have questions about exchange after this presentation, then feel free to find one of us. Nodal Exchange was born out of the need to have more granular risk tools for the North American power markets. So it was founded by some market participants. It started as an idea. Dimitri worked on that idea very early on, and it brought us to launch the exchange in 2009. What we ended up doing was really bringing to the market the ability to more specifically hedge your risk in the North American power markets. At a time, if you remember 2008, where moving business off of bilateral deals into cleared markets was a big push because of the financial crisis. And what people realized during that crisis is that you don't necessarily want to be exposing yourself to all of the different counterparty risks that you have. And so by having an exchange, and an exchange that is cleared, what you are doing is you're allowing the market participants to remove one of the risks that there is in doing these forward deals or these future deals. And so having Nodal Exchange in place when it was allowed us to grow, not only because we were providing robust contracts, but we were also providing much better margin methodology. And so that's been one of the differentiators for us as an exchange. It's allowed us to grow to about 34% of the power market that we deal in. We're only second in the industry. We are challenging exchanges like CME and ICE. We had this first event in New York on Tuesday. Between Tuesday and today, we're now, for the month of February, the largest North American power exchange, and we're clearing more futures contracts than any of the other exchanges. So we're growing, and that ability to manage that risk and to do it with a robust set of contracts, but also a really robust margining tool, is why FreightWaves and the marriage was so good, as Mike was describing. If you're not super familiar with exchanges, so the exchange is a place that provides a standard contract, provides the forward curves for those contracts, provides access to a large group of counterparties. So historically, as I was mentioning, if you're not clearing a futures contract, then you're exposing yourself to different counterparties. And in an exchange world, what happens is you become a member of the exchange, and as a member of the exchange, they're really the buyer and seller to every transaction. You're never seeing the other side. The exchange, in conjunction with the clearinghouse, provides the risk management tools to protect you from the default of the counterparty on the other side. Integral to this whole process, in addition to the clearinghouse, is the FCM. So every customer who wants to trade a futures contract must do two things. They must become a member of Nodal Exchange, so a direct member of our company, but they also must partner with an FCM. So when we talk about risk mitigation, and you look at what happens if someone can't perform on their futures obligations. Really the first backstop is the FCM. So the FCM is onboarding customers that are joining Nodal Exchange to support their business. And what they're doing is they're understanding what the intentions are of that customer, what the wherewithal is of that customer, as well as making sure that there's just buy-in across the whole organization. So anybody who wants to participate in the futures market, step one is coming to us. Step two is talking to an FCM. There's a handful of FCMs in the room, if you don't mind. I'll ask you guys to stand up, because I know that at the end of this whole thing, raise your hand at least. So if you have questions about the process of going through and creating a clearing account, then these people are great to talk to you. They'll give you insight of what that process is. These are the FCMs that are currently members of Nodal Clear, so they can clear business today. There's a handful of FCMs. Obviously, this is a big opportunity for the entire market. And so there's new FCMs who are entertaining becoming members of Nodal, not only for our power business, but also for this business as well. But in understanding how the makeup is of trading the futures, again, you must become a member of Nodal Exchange. Contact us and Tom to understand what those requirements are. And then you also must have a relationship with one of these entities, or in the future, any entity that joins with us. It's worth noting as you kind of think about how to navigate these waters, if you have a banking relationship with one of these banks, it's a good place to start. You may already have a futures account. It's a good place to start. When I mean banking relationship, it's not a checking account or a savings account. It's a corporate relationship with the bank. Call them and tell them that you want to open up a clearing account, and they'll provide you more information on how to do that. In terms of execution, so as I mentioned, there's a division with the exchange of the clearinghouse. The exchange provides execution mechanism, and the clearinghouse provides the risk management tools. So in terms of execution, so Nodal Exchange, as I said, was founded in 2009 or launched in 2009. We grew over the following years to a point where we launched our own clearinghouse in 2015, which is a big deal, and one of the reasons that led Craig to our doorstep. Shortly thereafter, we got the attention of Deutsche Börse. Deutsche Börse is a large German stock exchange who manages EEX Group and Eurex, and one of the things that they have is a world-class matching engine. So this is a way for screen orders to come in to be matched at high speeds. And so over the last year and a half, we've been working to integrate that into our clearing house and exchange, and that was done and finished in November of 2017, so it's now live. To ensure, there are certain firms who may write directly to the matching engine, but most people access through a trading platform. And to ensure that people had a trading platform on day one, we partner with CQG. CQG's a name here in Chicago that many people recognize. And so they're the preferred, at the moment, the preferred partner for Nodal Exchange, and that they provide access to the matching engine, and people can access that once they're members of Nodal Exchange. Another way that people choose to transact is what they call off exchange. It's actually still through the exchange, but it's via voice brokers. And so they're termed block trades. The reason they're termed block trades is because they're typically bigger in size, and they're not, they're subject to regulations to make sure that they meet a minimum size requirement. And block trades happen either through voice brokers. So you're calling a broker and you're saying, hey, I want to buy the national average for 1,000 lots. And then he'll have a network of sellers or other counterparties that he can go to and try to find you a seller and match you up. Once they do that, the broker can then go to the exchange and submit it for clearing. Additionally, you may have a relationship directly with the counterparty that's already on Nodal Exchange, and you don't want to use a voice broker, and you know that there's who the seller is for the thing that you're trying to buy, and you can contact them directly, and they can come to the exchange. All of these execution mechanisms are coming to us as cleared futures contracts. And what that means is we're providing a level of risk management. A term you may hear is variation margin and initial margin. Those are two ways that we protect the market from price moves. And so initial margin is looking at what is the risk of holding this contract and how much should we hold as an exchange in the clearinghouse. And then variation margin is us truing up twice daily as prices. So say you're trading January of 2020, and there may be a view today that is $1.50. Well, tomorrow that view may go from $1.50 to $1.60. As we remark those contracts, then we're going to change money between hands really twice a day. And so what that means is that the market's never really getting that far out of sync. It's not that you're sitting there with something that you contracted at $1.50 and you watch it go to $2.50 and you're wondering if the person at the, come January of next year is going to be there to perform. On a daily basis, you're truing up. So when you're making sure that the market doesn't get too out of sync of the variation margin. And so those, between initial margin and variation margin, those are ways that we can protect the market. In addition to the execution methods, FreightWaves and Sonar, if you guys aren't familiar with the platform, they've launched a great analytics tool. You'll be able to directly get to our front end through Sonar. And so by using that, you can come in. And so in addition to accessing the platform, we'll also be giving data back to Sonar. So you could be in Sonar and you can see what's happening in the futures market. One of the big things that we'll be able to do with the launch of the futures market is to see what the forward curve is all the way out to 16 months. And Tom will talk here in a second about what the contract is. But twice daily, Dimitri and his team will be marking the curve. So you'll have a forward view based off of what's transacting in the market and other information that's coming in from different sources in the market to see where the forward view is of those, either the lanes, the regionals, or the national averages. With that, I'll pass it to Tom, who's going to talk about the contracts.
Hi, I'm Tom Allen, and so up here you see a pictorial of the lanes that we've identified for the trucking freight futures in accordance with Nodal and DAT. What we've done is we've identified 7 lanes, origin-destination pairs between Seattle and LA, LA back to Seattle, LA to Dallas, Dallas back to LA, and then the triangle in the east, Chicago to Atlanta, Atlanta to Philly, Philly back to Chicago. And we identified these lanes in accordance with, DAT and Nodal. DAT, as Mike referenced, is, if you're familiar with energy, they are the Platts of the trucking industry. They do price assessments on about 18,000 or so origin-destination pairs every day. And from those 18,000 origin-destination pairs, we identified these 7 lanes. And the reason why we identified these 7 lanes is that about 22% of all freight is moved along these lanes, with a correlation of about 83% to the national market. So the lanes we've selected are very representative of freight movements throughout the U.S. So we've got 6 cities up there. We've got the 7 lanes. From those 7 lanes, we've also created 3 regional baskets. So in the west, we've got the round trip between Seattle and LA. In the south, we've got the round trip between LA and Dallas. And in the east, we've got the triangle. And then from those 3 regions, we also have a national average. So in total, we've created up to 11 futures contracts, which will be listed on Nodal and launched on the 29th of March. So again, we've got the 11 contracts. These are monthly contracts. They are cash settled, and as Mike said, there will never ever be a truck that will show up. They are settled off of the DAT spot indices that are calculated on a daily basis. On a daily basis, the contracts will be settled based on trading activity on the Nodal exchange as well as market assessments. The monthly settlement will be based on the average daily settlement as produced by DAT over the course of the month. As I say, the settlement is daily. Positions are marked to market on a daily basis. These contracts are dry van only. They are line haul rate, meaning there is no fuel charges associated with the rate. There is no accessorial charges associated with the rate. These are the actual price that it takes to move a load that was picked up and moved along one of the lanes. The contract size is 1,000 miles. That's the standard for it. The price is in dollars and cents per mile. And as Danny alluded to, the forward curve goes out 16 months. So you can trade trucking freight futures out up to 16 months forward. And then a little bit more about our index partner, DAT. They are the ones that have come up with the methodology. The methodology is based on the fact that they are, collecting about 256 million transactions on an annual basis with a notional value of about $60 billion. So obviously, they're collecting a lot of freight. And these rates are based on loads that are actually picked up, meaning a truck has actually picked up a load and has taken it away from the dock. They are electronically submitted, so we are not getting phone calls, or DAT is not getting phone calls in, saying, well, we think we're going to do a deal for, X dollars and cents per mile. These are actual electronic prices of freight that is being moved. What I want to do now is just take you through a quick simulated exercise on how a trucking freight future could be traded. This is illustrative in nature. This is not the CQG platform that Nodal has built out, but I just want to give you a flavor for how a trucking freight future could be traded. So what I have here is I just pulled up the FreightWaves Sonar platform, and within FreightWaves Sonar, we've built in an educational trading simulator. So I'm going to launch that now. And what I've pulled up is, a very fundamental trading screen. On the top component, you'll see your account balance and information. This would be the account information that is set up by the FCM, which includes margining, includes account balance, and it'll include any P&L that is accrued to that account. In the middle part is the trade and information component of the screen. So I can drop down and show the various instruments that are available for trading. And in this example, I've only listed the averages, so the regional averages plus the national average. At the bottom part of the screen is your position management capabilities, as well as your order tracking capabilities. And then to the left side of the screen is your order book, as well as the ability to look at market information in a chart. So in this scenario, I'm a shipper. And right now, rates in my mind and through my analytics are relatively low, favorable for me as a shipper. My fear as a shipper is that they are going to begin to rise. And so what I'm interested in doing is protecting myself from rising rates. So in this scenario, I'm going to go look, and I'm a shipper on the West Coast, so I'm looking at the West regional average. So in this scenario, I'm going to look at the West. I'm going to look at the futures markets that are able to trade in the West. I know as a shipper that over the next couple of weeks, I've got about 20,000 miles worth of freight I'm going to be moving. So I'm going to want to protect that, my rates. So what I'm going to do is I'm going to look to buy a February futures contract. So I click on the futures contract. I want to place an order into the market. I go to place an order. What I'm going to do is put in 20,000 miles worth of futures contracts, which is 20 contract equivalents. And I'm going to buy those futures contracts. And you'll see at the bottom part, in the February Western average, I'm now long 20 futures contracts at $1.884 per mile. As time elapses over the next couple of weeks, my freight begins to move. I'm going to want to unwind my hedge, so I'm going to go back into the futures market. I'm going to select my February contract again, since that's the contract that I'm long in. I'm going to go and place an order, and in this scenario, I'm now going to sell those 20,000 miles worth of futures contracts. So I'm going to sell 20 February futures contracts. And I've now unwound my position. So in this hypothetical scenario, I just wanted to demonstrate that you would use futures contracts in this scenario to hedge your position. If you're a shipper, you're looking to protect from rising rates. So I bought a futures contract and I liquidated to sell and thus produced my hedge. And with that, I'm going to turn it over to Kyle Lintner from K Ratio.
Apologies for the notes, but some of what I have to say demands accuracy. All right, thanks for coming out. My name is Kyle Lintner. I am a principal at a firm called K Ratio. We are a NFA member and CFTC registered CTA. For those of you not familiar with the acronyms, that just means that we are legally allowed to offer advice, risk management, and our opinion on futures markets. With all that in mind, I think the first thing to highlight, some of this you might have heard already, but this bears repeating. We're talking about missed earnings here. If you are a shipper, which 40% of the S&P 500 cited transportation costs as the key driver for their adverse profitability. That's a large amount. And we're not talking about quarterly or even annual problems. This is something that moves forward. We're talking about a lower stock price if you are a publicly traded company. If you are a private company, we're going to lower your annual EBITDA and take that against whatever industry multiple you operate in. This is a significant problem going forward. Upsets investors. It drives down your enterprise value. It's estimated that 5 to 14% of the cost of goods sold is directly related to the transportation expense. So I don't know whatever your size company you are, but 5 to 14% is an extremely large amount that is subject to extreme volatility in the marketplace. This is all unhedged volatility until we get to March 29. We're talking about taking a variable cost to a fixed cost. So this would be the shipper example. Your freight spend is something that, like Mike mentioned earlier, you can stick your finger up in the air and hope that it makes sense. You can't provide accurate guidance going forward because you're just throwing darts at the wall. You don't know what it's going to be. This tool provides the ability to look forward and see what rates are implied to be. It also allows the opportunity for those rates to be locked in effectively. Pardon me. We can reduce your input costs. We will reduce the price of your product, which leads to greater profitability. As we got to 2018, there was a 30% increase in rates. Within that 30% from Jan 18 to present day, we saw swings greater than 60% in volatility. That is not advantageous to anyone trying to plan their business. So how it would look as far as the shipper is concerned, for this example, I thought we would just go with the DAT national average. You see the peaks, you see the valleys. Obviously, the summertime was not very nice for anyone who was shipping. Currently, we're sitting at rates not seen since 2017. You see it in the green right there. This is the most advantageous time for any shipper to lock in rates. What you would get in the market now is what you could plan your business for 19 and possibly 20, because these will be 16 months listed forward. Carrier, same idea. Instead of cost, we're talking about revenue. We want to take out that uncertainty. You'd like to know what your trucks are going for, what you're getting in return for those trucks. It's not the cost, but this is the revenue coming in. Same idea. You'd like to be able to plan effectively. You'd like to be able to lock these in effectively. We're trying to take the volatility out of the marketplace. For the carrier, same chart. This is January to January from 18 to 19. I'll take it to July, June. That's the peak you see at $2.09 on average. If I would have asked you in July what you think we would be currently at now in February, not a single person, not one of you in the room would have told me we'd be down here. All of us were wrong. This isn't something we're talking about making money in. We're talking about preventing losses. If you were a carrier, locking in your rates when we're sitting at 209 is a lot better than doing it now at $1.49. This last part to me is the most important, possibly going forward with this new market. This is for the 3PL. It's our opinion that the 3PL stands the most to gain and the most to lose in this new market. Those that adopt this tool will succeed. Those that don't will likely perish. The 3PL will have to maintain a short and long position at the same time to remain competitive. I know sounding long and short would imply that you are delta neutral, but you are not, because they operate in two different products. If we look again to the national average, this would be the revenue side of it. As the broker, you would like to know within reason what you're estimated to receive in revenue. Operate with a short, much like the carrier, lock in the high rates we saw in July instead of the $1.43 now. The twist to it is on the expense side. If you are a 3PL with overwhelming majority, the odds are you are booking your trucks in the spot market. I don't care if it's contractual freight or it's spot freight, you're in the spot market. If you can take your longs on a lane-specific micro level instead of the macro level on the national. In this instance, I have LA to Dallas. Let's say you're contracted LA to Dallas. It would be more advantageous for your company to have rates low and smooth than subject to the peaks and valleys. If you booked your LA to Dallas at $2, let's call it, we're going at $1.80, everything's fine. We come up to July, you're above $2, okay, you're sucking wind. How long do you want to take the losses to keep primary? I don't know, that's up to you. By the time we get to the end of the year, now we're up to 250. You don't have to bail on that lane if you've locked in the hedge. And this isn't something that's going to stick around just for right now. This won't be the losses spoken in 2019. This is something that will go forward. This gives you an idea where you can price your future RFP business. This gives you a place where you can effectively lock in your future RFP business, because you're shifting that risk premium that you've put into your RFPs and you're placing it in the marketplace. And that is the entire idea of how a futures market looks. We're just trying to take volatility out, give it to someone else, and get it off of your books. I know some of these topics were a little complicated in nature. If you'd like to discuss them further, we will be around. I'll be here for the cocktail hour. My business partner, Pat, he's another principal at K-Ratio. He'll be here. We can uniquely tailor these needs to how your business works. We are a subsidiary or a division of a 22-year-old freight management company called K&L Freight. We also have a satellite scientist, a NASA scientist, statisticians, mathematicians. Personally, I have over 20 years experience in the futures markets, the last 15 or so trading my own account with futures, stocks, bonds, currencies, options. I've been a member of the Chicago Board of Trade since 2006, so we have all angles covered. And with that, I would like to bring all the panelists back up and open it up to Q&A. No one? Did we do that good? No questions? Yes?
We're going to bring a microphone out so the live stream can hear you. So, yeah. Sorry.
If you wouldn't mind repeating that, please.
What do you think the margin will be per contract?
It's a Dimitri question.
I could go back to my computer and look that up. I don't have that memorized. The key thing is that this is not a fixed dollar amount that you just look at a contract and you can think there's always the same dollar amount that you're adding. We use a portfolio margining. So if you add two contracts into, or two or three different contracts in your portfolio, the nature of your portfolio and the offsets associated with it will determine the contract risk amount. So I can, to give you, if you just had a single contract, I can let you know in 10 minutes when I look at my.
Yeah, I think last we had looked, it was around 10% of notional. But again, to Dimitri's point, margin methodology takes into a lot of complexity, so that can change depending on how you're trading.
How's the backwardation in contango going to work?
Sure. I don't know where that came from, but the answer is both. I could possibly get you something, but I will say that this will not be an instance like treasuries where we have a yield curve per se, or even an agricultural and energy market. Due to the seasonality of freight, you'll have some months priced higher than others. It will look similar to the pricing chart. July is going to be a lot more than October. There'll be a little bit of play, but it won't be something smooth. I tell you what, I'll give you $1 million if it's 2 years. This is just the line haul from the origin to destination aspect of the truck. So even if it is autonomous, you're still commoditizing the service of that. So your Uber truck would still be eligible to be hedged in the market. In the back.
Yeah, what kind of confidence do you have on the historical rates that you're basing the contracts off from the DAT price? Because I've seen the API file, the rates I push them every day, and it's self-validated. There's no pay data or anything like that. So not to say anyone would,
Yeah.
but it's very trusting network of rates that are pushed to them.
Right. So Tony Salazar, I'm the CFO of DAT. It's a good question, right? It is a self-validated entry, and we're looking at a couple different things. First is the breadth of the inputs that we get, and then we have statistical analysis that we apply to the inputs, to the inputs and then also in the output, to ensure that we don't have an overweighting of any one contributor. So no contributor can be more than 49% of a lane rate. And then on top of that, we have a certain sample size that's required where we fall into a different methodology for developing that rate. And you know, the way we look at it is there's really two balances to it. Because we've got the breadth of that data and we use that back, or you know, a lot of you in the room use our rates service. And what it does is you've got a commercial aspect to it that's balancing against any gamesmanship. And so we're really looking at its breadth of network coupled with some of the statistical analysis and what we would say is you know, anything that looks out of order or is flagging a change in behavior for a different, or, you know, for a particular contributor. We would look at those things and then dig in deeper.
So it works as long as everyone's not doing it.
Pardon me?
So it works as long as everyone's not doing it.
As long as everyone's not gaming it?
Correct.
Yeah, absolutely.
How soon are you going to list options on your futures contracts?
First, we want to launch the futures contracts, and from there, once we get liquidity, we'll look at other instruments to launch, whether they be shorter data instruments or even options. So, but not on March 29th.
What if you're shipping outside of the 7 lanes? You know, you're a shipper from Florida, whatever. Is there a way to find a correlation?
Yeah, I mean, these are cash settled contracts. You know, they're not reliant on trucks moving on these specific lanes. So there is a correlation between each of these lanes and the regions. And so, you know, that's how these contracts will be applied to that type of situation.
So, so I guess from a shipper's perspective, if you know you have facility A in Madison, Wisconsin, and you're headed down to Tallahassee, that may look like Chicago to Atlanta, but it may not. So it may look like Philly to Chicago 2X with a splash of Seattle to LA. We really don't know, but that's part of what the services that we offer is by consuming your data as a shipper. As a shipper or a carrier, and being able to see how that is going to perform against the marketplace.
When you say we, you mean K-ratio.
Correct.
That's what you're going.
Yes.
Yeah, and additionally, I mean, I think a number of you in the room are familiar with the DAT products, right? But we've got all the underlying data from, you know, key market area to to 3-digit zip codes. And so if you had analysis that you wanted to do within your own companies and look at that, I mean, the underlying data exists. It's just a matter of then developing the right basket of the indices that would best protect your position.
So that's a common. I mean, so what exchanges do is they launch new products, right? And so working with FreightWaves and working with DAT, normally what happens is someone has interest in trading something new. They may start off using the same brokers doing something non-exchange, using some kind of swap, but to the degree that becomes of interest and more parties want to do it, that comes to our attention and we work with our partners to launch the contract. So that's the natural evolution of how we have as many contracts as we have.
You guys have DAT signed a confidentiality contract, so no inside competition before the index pops up?
Yes, and in fact, that's a requirement from the CFTC.
Yeah, the question was, and I don't know, maybe there's a simple answer to this, but maybe why Chicago to LA wasn't a part of the contract lanes?
Yeah, so the 7 lanes that were selected, approximately 23% of freight moves on those lanes, right? And originally there were 18 lanes, but removing them down to those 7 moved it really from 25 to 26% to 23%. It wasn't statistically enough to keep some of those lanes. And so to keep the liquidity high and interest high and the trading high at launch, it was one of those lanes that was cut.
how wide will the markets be? Like a penny wide, a nickel wide? Is there even a rough idea of like 6 months out how wide the market will be?
No, we don't know how wide they'll be. You know, what we're doing is we are working with a number of entities, you know, to be liquidity providers, to keep the bid-ask spread, you know, as narrow as possible. But we have no way to you know, to forecast that at this point in time.
Will there be any market maker programs?
Yes, we are in the process of working with Nodal and to create various liquidity provider programs, and so there'll be more information about that very shortly.
As most of people know in the room, most of the truck capacity in this country is small operators, mom and pops that have 6 tractors, which is surprising to a lot of people. How do you expect to get those people participating in this? Because a lot of the data activity is the small-time operator, and you need them involved too.
You are right, and I think the number is 91% are 10 trucks or less. So that is mom and pop. Regardless of the size of them, I don't know the immediate effect of it. I think this will be something adopted by the larger to begin with. As this market becomes more mature, it's conceivable we could have something similar to like an agricultural model where there's a co-op. You could have the Northwest Indiana collection of carriers, and whoever wants to service that area, be it county or XMA, pool it up, spread it around, depending on what your risk involved is. I know there's certain limitations to joining Nodal that might exclude some, but once the market becomes open and moves past its infancy stage, I think all of that will get ironed out. I would say most likely not, and I don't think that's the worst thing. Those with the most to lose stand the most to gain initially with this new product.
So that's exactly where we are today, and I would agree exactly with your assessment that as the market evolves, likely would have newer players coming in. The Nodal exchange currently is a principal-to-principal market, so it's not for small mom-and-pop traders. But we are, over the next year to year and a half, looking to add what's called trade intermediation, which allows smaller players to be trading as well. So that will probably map, my guess, the evolution of the trading on for freight capacity.
All right, well, thank you all for coming. Thanks for the great questions. We have the networking meeting or cocktail reception, I suppose. It is upstairs, I believe, up on the roof. So please attend, and we can have further one-on-one discussions, trade some business cards, and set up some meetings. Thank you all.